Hi, it's Sir Rob. Today I am going to talk about the overview of the accounting cycle with the theme, Accounting Cycle, a framework for financial integrity and compliance. In this video, we will discuss the accounting cycle as a disciplined, multi-step procedure for accurately recording and reporting a company's financial data. This retrospective process, typically comprising 8 standardized steps, serves as the operational backbone of corporate financial reporting, ensuring data integrity, regulatory compliance, and the creation of legally defensible financial statements. Its core purpose is to translate all business transactions into standardized reports for external stakeholders, like investors and lenders. At the end, we will also look at the impact of system modernization from the traditional manual to an IT-based computerized system, which includes robotic process automation, RPA, and cloud computing. We will also look at how the role of the financial expert has evolved because of this method upgrade. As always, in the practice of accountancy, we should remember to be professional, perform effectively and efficiently, follow standards, and document our work adequately and properly. The topics of this lecture video are 1. Conceptual foundation and strategic importance, which includes a discussion of the definition and temporal scope of the accounting cycle, strategic context, accounting cycle versus budget cycle, and the accrual basis, mandate, and underlying principles. 2. Phase 1. Transaction capture and preliminary recording, steps 1 to 4. Step 1. Identification and analysis of transactions. Step 2. Recording transactions in a journal, also known as journalizing. Step 3. Posting to the general ledger. Step 4. Preparing the unadjusted trial balance, or UTB. 3. Phase 2. Internal controls and the adjustment process. Steps 5 to 7. Step 5. Analyzing the worksheet, an internal planning tool. Step 6. Creating and posting adjusting entries. Step 7. Preparing the adjusted trial balance, or ATB. 4. Phase 3. Formal reporting and cycle finalization, steps 8 to 10. Step 8. Generating formal financial statements. Step 9. Closing the books. Step 10. Preparing the post-closing trial balance, or PCTB. And the last topic is 5. Operational efficiency and system modernization, which includes the subtopics, the transition from manual to computerized systems, and strategic implications of automation, RPA, and cloud solutions. And off to our first topic, conceptual foundation and strategic importance. Definition and temporal scope of the accounting cycle. The accounting cycle is formally defined as a consistent framework and disciplined procedure designed for accurately recording and reporting financial data within a specific, defined accounting period. This essential process consists of a structured series of typically 10 steps used to manage a company's entire bookkeeping operation during that defined fiscal span. The duration of the accounting period is not fixed and depends entirely on the operational and analytical needs of the company. While some organizations adopt shorter internal accounting cycles, such as monthly or quarterly periods, others may maintain annual cycles for external reporting purposes, regardless of whether the company is analyzing its fiscal performance over a 30-day span or a full year. The fundamental sequence of 10 steps remains standardized and unchanged. The overarching goal of rigorously following this cycle is to ensure the complete financial integrity of the organization, support regulatory compliance, and provide accurate, timely documentation of the business's financial performance. Adherence to this consistency is critical for producing necessary tax documentation, calculating taxes owed on profits, and generally strengthening internal controls over financial data. Strategic context. Accounting cycle versus budget cycle. It is imperative to distinguish the accounting cycle from the budget cycle, as they serve different purposes and audiences based on their temporal orientation. The accounting cycle is retrospective. It looks backward by capturing, organizing, and reviewing actual financial transactions that occurred during a completed period to generate accurate reports. The results of this cycle are primarily intended for external audiences, such as investors, lenders, and regulatory bodies. Conversely, the budget cycle is prospective and forward-looking. It focuses on forecasting revenues, estimating expenses, and allocating resources for future periods, typically spanning a full fiscal year. Its projections are strictly for internal use by company management to guide future operations. A critical organizational reality arises from this temporal difference. The accuracy and uniformity achieved through the rigorous application of the accounting cycle create the essential foundation for strategic decision-making and forecasting. The output, reliable financial statements detailing past performance, is the necessary prerequisite data required to build effective models and strategic budget forecasts for the future. Therefore, the time and resources committed to achieving efficiency and integrity in the accounting cycle represent a crucial investment in the organization's strategic planning capability, not merely a cost of regulatory compliance. The accrual basis mandate and underlying principles. The necessity for several complex and often time-consuming steps within the accounting cycle is dictated by the adherence to accrual accounting principles. Accrual accounting is required for most external reporting standards, like GAAP and IFRS, because it recognizes revenue when it is earned and expenses when they are incurred, irrespective of when the physical exchange of cash occurs. This approach ensures that a company's financial reports reflect its true economic activity over the period. Aligning with the revenue recognition principle and the matching principle, this contrasts sharply with cash accounting, which only registers a transaction when cash changes hands. For example, under cash accounting, prepaid rent is an expense only when paid, whereas accrual accounting requires the expense to be spread over the time the asset is actually used. The cycle must accommodate this nuanced treatment, necessitating complex adjustments detailed in Phase 2 to correctly reflect the business's position. The adherence to the cycle transforms raw data into a structured compliance mandate. If a company deviates from the established steps, the resulting reports are considered unreliable and fail to meet the stringent audit and tax standards required by external stakeholders. Let us now look at the transaction cycle, its 3 phases, and the steps in each of the phases, starting with
Phase 1, Transaction Capture and Preliminary Recording, Steps 1 to 4. This initial phase establishes the comprehensive audit trail and the mathematical validity required by the double-entry bookkeeping system. Step 1, Identification and Analysis of Transactions. The cycle commences with the identification and analysis of all financial events occurring during the accounting period, including sales revenue, debt payments, and various expenses. This step is the most crucial as it requires determination whether the event is a financial transaction and therefore must be recorded, or a non-financial transaction which would not require update of the accounting books. This process relies entirely on source documents, which serve as the fundamental cornerstone of accounting records. Source documents such as receipts, invoices, bank statements, or payroll records provide tangible, verifiable evidence that a financial transaction actually took place. These documents may be in physical form or traceable electronic formats. The integrity of all subsequent records depends heavily on the accuracy of these initial source documents, as they establish a clear audit trail and ensure compliance with legal requirements. After identification, each transaction must be analyzed, often using the fundamental accounting equation to ascertain which specific accounts are affected, and whether the change requires a debit or a credit entry. Step 2. Recording transactions in a journal, also known as journalizing. Once transactions are analyzed, the data is chronologically recorded in the General Journal, or the Book of Original Entry, creating a comprehensive, organized record of every company transaction. This process mandates the use of the double-entry accounting system, a foundational principle that requires every transaction to affect at least 2 accounts such that total debits always equal total credits. This inherent self-checking mechanism standardizes the recording process and significantly aids in the detection of errors. The application of debits and credits adheres to consistent rules based on the account type and its normal balance. Debits are conventionally entered on the left side of a ledger account, while credits are entered on the right. A debit increases asset, expense, and drawing accounts but decreases liability, revenue, and capital accounts. Conversely, a credit increases liability, revenue, and capital accounts. while decreasing asset and expense accounts. Step 3. Posting to the general ledger. Following journalization, the entries are transferred or posted to the general ledger or GL, also known as the Book of Final Entry. The general ledger organizes the financial data, serving as the master repository that summarizes all transactional activity for every individual account, for example, cash, accounts receivable, cleaning revenue. This step consolidates the details from the journal into account-specific summaries. After all transactions are posted from the journal to the ledger, the debits and credits of each account in the ledger are totaled and the ending balances are computed. In modern environments, computerized accounting systems often automate this posting process instantly or upon approval, often generating subsidiary journals simultaneously. For classroom purposes, we will use the traditional T account as summarizing tool of the general ledger. In the second semester, in Part 2 of this course, we will practice posting financial transactions to the general ledger. Step 4. Preparing the unadjusted trial balance, or UTB. The cycle's first major checkpoint is the preparation of the unadjusted trial balance, or UTB, a report listing the balance of every general ledger account prior to any period-end adjustments. The primary function of the UTB is an initial control check to verify that total debits reported across all accounts mathematically equal total credits, confirming that the double entry system has been mechanically followed. Phase summary. The sequence established across these first steps, source documents to journal to ledger to UTB, creates a vital traceability chain. For auditing purposes, any figure reported in the financial statements must be verifiable back through the ledger and journal to an underlying source document. This systematic documentation minimizes the risk of undocumented or unauthorized transactions. While the UTB confirms mechanical accuracy, it is important to understand its limitation. It is an incomplete internal report and does not account for necessary accrual adjustments or potential errors that maintain the debit-credit equality. Extreme attention to detail is required in this phase, as errors made early on, especially in manual systems, can necessitate a complex and time-consuming reversal back to the beginning of the process to locate and correct the mistake. The rise of computerized accounting minimizes mechanical calculation and transcription risks, but shifts the control focus to the initial data input and the correctness of the software's configuration, which must accurately classify transactions and apply the double entry rules.
Phase 2. Internal controls and the adjustment process. This phase is crucial for applying accrual accounting principles, ensuring that the financial reports reflect the economic reality of the period, rather than merely the timing of cash receipts and payments. Step 5. Preparing and analyzing the worksheet, an internal planning tool. Before formal adjustments are made, many accountants utilize an accounting worksheet. This is an internal, non-mandatory spreadsheet used strictly for analytical purposes and is not intended for external stakeholders. The worksheet acts as a crucial pre-posting quality control mechanism, typically summarizing the unadjusted trial balance, potential adjustments, the resulting adjusted trial balance, and the preliminary income statement and balance sheet figures. This tool allows accountants to organize and test potential adjusting entries, investigate discrepancies, and confirm the balancing of the accounts before formally journalizing the adjustments and permanently updating the general ledger. It is also a temporary record that allows for the safe preparation of 2 sets of financial statements, and serves to ensure that all financial statements are accurate and complete. Step 6. Creating and posting adjusting entries. Adjusting entries are non-cash journal entries recorded at the end of the accounting period to update account balances and adhere to the revenue recognition and matching principles. These entries are required whenever the cash flow occurred in a period different from the economic activity. For example, they account for the systematic spreading of a prepaid cost over the months it provides value, such as amortizing a 10,000 pesos annual software subscription into 200 pesos monthly expenses. Adjusting entries typically involve one income statement account, a revenue or an expense, and one balance sheet account, an asset or a liability. The categories of adjusting entries address the timing mismatch inherent in recording cash transactions. 1. Accruals. Accruals recognize revenue earned or expenses incurred for which cash has not yet been received or paid, respectively. Examples include accrued rent, an expense incurred but invoice was not received yet, or accrued revenue, credit sales, where goods were delivered but payment is still pending. 2. Deferrals or prepayments. Deferrals recognize cash exchanged prior to the economic activity being fulfilled. This includes deferred revenue or unearned revenue, where cash is received upfront for future services, and deferred expense or prepaid expense, where cash is paid upfront for future benefits, for example, prepaid insurance. 3. Non-cash estimates. These adjustments recognize the consumption of assets or estimated future non-collectible amounts. These include depreciation and amortization. Depreciation spreads the cost of tangible fixed assets, for example, a delivery truck, over their useful lives, while amortization does the same for intangible assets, for example, a franchise contract. This process ensures the expense is matched with the revenue generated by the asset's use. If these adjusting entries were omitted, the financial reports would present a materially inaccurate depiction of the company's performance, overstating or understating assets and expenses, thereby failing to comply with reporting standards. Step 7. Preparing the adjusted trial balance, or ATB. The adjusted trial balance, or ATB, is prepared immediately after all adjusting entries are formally recorded and posted to the general ledger. The ATB serves as the critical bridge between bookkeeping and formal reporting. Unlike the UTB, the ATB lists the accurate, finalized account balances that capture the full scope of financial activity, including all non-monetary adjustments. The primary purpose of preparing the ATB is twofold. First, it confirms that total debits remain equal to total credits, even after incorporating the changes required by accrual accounting. And second, it provides a definitive listing of account balances to be used directly in generating the formal financial statements. If the ATB balances, it signifies that the foundation for financial reporting is sound, enhancing financial accuracy and improving decision-making. Phase summary. The sequence established across these 3 steps, preparing and analyzing the worksheet, to creating and posting the adjusting journal entries, to preparing the ATB, helps ensure that account balances are accurate at the end of the period before preparing the financial statements. First, preparing and analyzing the worksheet helps organize the unadjusted trial balance and identify which accounts require adjustments. The worksheet acts as a planning tool to review the accounts and determine the necessary adjusting entries. Creating and posting the adjusting journal entries updates the general ledger account balances from their current balances to their accurate balances. Finally, the ATB verifies that debits still equal credits and provides the corrected and final account balances. These updated balances are then used as the basis for preparing accurate and reliable financial statements. Hands-on activity on all steps of Phase 2 will be administered in the second semester.
Phase 3. Formal reporting and cycle finalization, steps 8 to 10.
This final phase transforms the validated data into standardized reports and prepares the organization's records for the next accounting period. Step 8. Preparing a formal financial statements. Using the verified balances from the adjusted trial balance, the company generates its formal financial statements. This step must adhere to a specific chronology because the result of one statement is required for the preparation of the next. 1. Income statement. This statement is prepared first, utilizing all revenue and expense accounts from the ATB to calculate the net income or net loss for the period. 2. Statement of retained earnings or equity. This statement uses the net income or loss figure derived from the income statement combined with beginning retained earnings and dividends to calculate the ending retained earnings balance. 3. Balance sheet. This statement includes all permanent accounts, assets, liabilities, and stockholder equity accounts, including common stock and the newly calculated ending retained earnings. This chronology is necessary because the net income must flow into equity to ensure the balance sheet adheres to the fundamental equation: assets equals liabilities plus equity. Step 9. Closing the books. Closing the books is a critical internal governance mechanism that enforces the periodicity principle in financial reporting. This step involves preparing closing entries to finalize and zero out all temporary or nominal accounts, revenues, expenses, and dividends which relate only to the performance of the period just ended. The process transfers the net effect of these temporary accounts, which is the net income or loss, into the permanent retained earnings account on the balance sheet. Permanent accounts such as assets, liabilities, and equity accounts carry their non-zero balances forward into the subsequent period. By zeroing out the temporary accounts, the integrity of comparative analysis is preserved, ensuring that the next period begins with a fresh, clean slate for tracking new performance metrics. Step 10. Preparing the post-closing trial balance, or PCTB. The post-closing trial balance, or PCTB, represents the final step and an essential internal control check that completes the cycle. The PCTB lists only the permanent balance sheet accounts, as all temporary accounts should now possess a zero balance and are consequently excluded. The purpose of the PCTB is to confirm to specific internal controls. First, that total debits still precisely equal total credits among the remaining permanent accounts. And second, that the closing process successfully zeroed out all temporary accounts, preventing any contamination of the new period's performance tracking. A balanced PCTB confirms that the ledger is ready for the new accounting cycle to commence. Phase summary. The sequence established across these 3 steps: preparing the formal financial statements to closing the books to preparing the post-closing trial balance, helps ensure the accuracy and completeness of the financial reporting process. Preparing the financial statements is significant because it summarizes the company's financial performance and position, providing useful information to management, investors, creditors, and other stakeholders for decision-making. Closing the books is important because it resets the temporary accounts, such as revenues, expenses, and withdrawals, to zero, ensuring that the next accounting period starts fresh and that income and expenses are properly measured for each period. Preparing the post-closing trial balance is crucial because it verifies that all temporary accounts have been closed correctly and that only the permanent accounts remain with their correct ending balances. This step confirms that the ledger is balanced and ready for the next accounting cycle, supporting accuracy and consistency in financial reporting. Hands-on activity on all steps of Phase 3 will be administered in the second semester in Part 2 of this course.
Operational efficiency and system modernization. While the logical sequence of the accounting cycle is fixed, modern technology has fundamentally transformed its execution. The transition from manual to computerized systems. Manual accounting systems are inherently time-consuming, requiring laborious data input, manual calculations, and high labor costs. They are prone to calculation errors, omissions, and mispostings, and correcting errors often involves messy, complex recalculations across multiple accounts. Computerized accounting systems have revolutionized this process by dramatically improving efficiency and reducing transactional risk. Software can process transactions in seconds, automatically classifying entries, updating related accounts, calculating necessary figures, like taxes, and adjusting inventory levels. Furthermore, computerized systems feature built-in checks and error alerts, minimizing human error. When adjustments or corrections are needed, modern software systems handle these elegantly, automatically updating all affected balances while maintaining a clear, professional record of the changes, greatly simplifying audit review. Strategic implications of automation, RPA and cloud solutions. The transition to computerized systems, often incorporating cloud-based solutions and automation technologies like robotic process automation, or RPA, offers profound strategic benefits beyond mere efficiency. Report generation, which might take several days in a manual system, becomes instantaneous, allowing businesses access to real-time financial information and customized reports for better decision-making. Furthermore, the trial balance, a manual chore in older systems, is generated automatically and is always available upon request. This automation minimizes mechanical labor, enabling financial professionals to shift their focus from repetitive bookkeeping, steps 2, 3, 4, 7, to strategic decision-making, analysis, and exception handling. This change alters the cost structure of the business. The long-term cost benefits of computerization, despite software maintenance costs, typically outweigh the high ongoing labor costs associated with manual data entry. Most importantly, this efficiency is a direct driver of organizational scalability. By automating routine tasks, a business can handle significantly larger transaction volumes without needing a proportional increase in accounting staff, thus removing a critical growth bottleneck and improving the firm's operating leverage. The financial expert's role evolves from a data processor to a financial interpreter and control system architect, ensuring the initial transaction analysis, step 1, and the complex adjustment policies, step 6, accurately reflect legal and economic standards. In summary, the accounting cycle stands as the definitive operational backbone of corporate financial reporting. Its rigorous, multi-step sequence, anchored by the discipline of double-entry bookkeeping, is essential for translating complex business activities into standardized, compliant financial data. The necessity of Phase 2, the adjustment process, ensures that reports adhere to the accrual basis of accounting, presenting economic reality rather than simply cash movements, which is paramount for investors and lenders. The efficiency gains realized through system modernization have not made the expertise of the accountant redundant. Rather, the expertise required has shifted. While technology handles the volume and mechanical accuracy, the human element remains vital for the initial analysis of transactions and the complex judgment calls required for adjustments and estimates. Consistent, accurate execution of the accounting cycle provides a clear, verifiable audit trail, reinforcing internal controls and establishing the corporate financial statements as a legally defensible representation of performance. Ultimately, the quality and integrity of the output from the accounting cycle directly constrain the effectiveness of a company's future budget forecasting and long-term strategic planning. There it is! Chapter 5, Overview of the Accounting Cycle, with its 10 steps and the profound strategic benefits of system modernization, transforming processes from manual to IT-based computer processes. On the slide are the references used in the making of this lecture video. Thanks for watching and stay safe always.